Welcome back. This is Retirement News Online from our studios in Scottsdale, Arizona. Now, market volatility can derail even the most confident retiree, especially when income is involved. And a great advisor doesn't just, manage investments. They design strategies to help clients generate reliable income, even when, markets are moving against them. And joining me here to talk about this, once again, Tyler Meek with BayTrust Financial in Tampa, Florida. He's an advisor. He's a pretty good golfer, and he knows what he's talking about. So, dependable income. How do you generate that income when when markets are going down and without selling in a down market, selling investments at that time?
Yeah, it's a tough game. I mean, as we've seen over these last few years, markets have been pretty volatile for the most part, but it does become a tough game. And really, what we try to do with building out our clients' portfolio, we're big advocates for having transparency in the portfolio, knowing exactly what it is that we're owning and what we're doing at any given point in time. So having that transparency there to really make sure that we can solidify that we're in the proper asset classes, the proper sectors. It goes back into the old saying of, hey, don't have all of your eggs in one basket. We want to make sure that we're diversified across the market, whether that be through our investing strategy in our actual managed portfolios. If we're incorporating some sorts of structured notes, CDs, maybe an index annuity for some income supplementation if need be. And yeah, as we kind of make that transition to the retirement phase, and now that we're actually having to more than likely rely on our investments to supplement our income, we just want to make sure that we know exactly what it is that we're owning and we have in the portfolio at all times, just to make sure that we can, play that dancing game.
And for some of the do-it-yourselfers out there right now, so I think a lot of people, you and I talked about this before, the difference between naive diversification is what we call it, and I guess comprehensive diversification. So someone comes in, they've got a bunch of different accounts, they've got the 401k, you start looking under the hood and everything, they've got the same stocks on all of them, it's completely correlated. And I'm sure a lot of people are like that. How do you really then start to diversify everything?
Yeah, I mean, we run into it all the time. I've sat across the table from clients many a times where, they'll break out their statements, we'll look through them, we'll run certain reports to kind of give them that transparency, but a lot of times they'll say, hey, Tyler, I don't need a second opinion. I don't need, I'm very well diversified across the market. When we look at their statements, we see a lot of different funds and whatnot, which are good. Mutual funds aren't a bad thing, but we want to make sure that those funds or how we're allocated is in fact truly diversified. And when we start to peel back that cover and see what the funds are owning, we oftentimes see a lot of what we call overlap. Those funds are owning a lot of the same things. So if you have 10 different mutual funds in your portfolio, but all of those 10 funds are owning Apple, Amazon, Google, you name it, well then it really defeats the purpose of what they're meant for. So again, by being able to peel back that cover, seeing what we're owning, well then we start transitioning into talking about, hey, let's implement some direct ownership to give you that transparency and not be a naive investor, naive diversification, as we called it.
Well, and it's not their fault. They just don't. Nobody's talked to them about that. So sequence of returns risk is something that maybe a lot of people don't really know what it means, but it is critical. And it's all about timing. So how do you, when somebody has a 20, 30-year retirement, 40-year retirement ahead of them, you have to protect what they've worked so hard to build. At the same time, though, we still have to keep our foot on the gas pedal. How do you manage that? Because they're mutually exclusive typically.
Yeah, sequence of returns is tough. I mean, again, going back to what I said a few minutes ago, the market has its ups and downs. It has its swings, and it is a timing game. And let's face it, we can try to time the market as best we can, but nobody has a crystal ball. So when we're taking distributions in retirement to supplement our income and we have a bad sequence of returns, a bad couple of years, well, that can put a lot of pressure on our investments. If we're taking 4 or 5% and all of a sudden we're in a 10% down market, that distribution rate gets very high. And now at that point, we're putting pressure on our investments, which is what we don't want, because hey, the whole conversation is we don't want to run out of money. So in this kind of scenario, this is where I would say implementing something along the lines of a fixed index annuity that has some sort of income-driven components can really help smooth out the ride. Because the index annuity, especially when we're talking about from an income standpoint, I always like to say, hey, we're creating a pension for ourselves, right? When you feel as though you are going to need to have an additional income stream in retirement, we can turn that income on and it's going to pay you out for the rest of your life, even if the account value were to ever reach zero. And the beauty of the annuity is, hey, it's principal protected, right? So we're still getting the same amount of income coming to us, even in the down market, so that helps smooth out the ride. I always like to use this little analogy to help people understand how the annuity actually smooths the ride out. Scott, I don't know if you're a gambler or whatnot, but just think of a blackjack table. We have two different blackjack tables, blackjack table A, blackjack table B. Blackjack table A is traditional. You put your $100 chip up. If you win, they give you $100. If you lose, well, hey, they take your $100 chip. Right. Then you have blackjack table B, which is the annuity. You put your $100 chip up. If you win, they say, hey, good job. We're going to give you $50 back. Good, gravy. But if you lose, you just take your $100 chip back. At what table do you think is there going to be a longer line? Probably blackjack table B.
Right.
So it really helps smooth out the ride, and knowing that we cannot lose any money in down markets is going to really reduce the pressure in the portfolio.
And I think a lot of people aren't even aware of that strategy. And again, these are some of the strategies that I think when you're thinking about long-term income planning, you can't rely entirely on equities and stocks. You have to bring in some things that aren't stocks, which are doing what you just described, which is protecting people over a long period of time and creating their own pension. Just imagine that. Tyler Meek, he's with BayTrust Financial in Tampa, Florida. Thanks for watching Retirement News Online. Find out more at retirementnewsonline.com.